Hello guys, in this video we'll discuss what smart money concepts are, also known as inner circle trading. Let's not waste any time and go straight to the video. My name is Ivan and welcome to Magnet Trade. Let's begin with structure concepts. Break of structure. Break of structure is used to identify if the current trend is going to continue. To find it, you have to look for the previous high and low. In a bullish break of structure, there has to be a high low and the high. In bearish, it's also straightforward, but you just have to look for a lower high and the lower low. Change of character. Change of character is formed when break of structure fails. In a bullish change of character, there must be a pattern of a bearish break of structure, and then the price doesn't continue to decline, instead reaching higher highs. For a bearish change of character, it's the same but in reverse. Bullish break of structure fails to rally, instead beginning to decline. A stronger type of change of character is change of character plus, which forms when break of structure fails to reach a lower low or a higher high, immediately going in reverse. Market structure shift, when a trend shifts without immediately reaching new extremes. Equal high or equal low. An equal high is a price level where the price fails to achieve a new higher high, stopping at almost the same level. Traders don't use it as an entry or exit point, but it shows that there is not enough momentum and the trend is likely to change, so they start looking for confirmations. Equal lows work in the same way, but form when the price fails to reach a lower low. Fair value concepts, FVG, created when the price steeply moves in one direction, without covering all orders within that range. Since markets try to retain balance while FVG is literally in balance, the price will tend to come back to that range, testing it. There are three types of tests, the first one being a very shallow test, when the price doesn't get to 50% of the FVG. This pattern usually happens in very small time frames, or when the price is likely to retest it one more time, usually called entry drill. The next one is 50% fill of FVG, a price level where the asset is likely to give a strong reaction. The last one and the strongest one is full fill, when the price goes all the way past FVG and then rebounds back. This type of test is the most reliable to follow, since one more retest is very unlikely, and the price will continue moving in the direction of FVG. IFVG, meaning inverted fair value gap, happens when, for example, bullish FVG is broken, and the next time it rallies back in the zone, it will serve not as a bullish sign, but as a bearish one. Balanced price range, BPR, is when two separate FVGs create a single zone, the rarest, yet the most powerful indicator. Since it combines both bullish and bearish parts, it works in the direction of the last FVG. Volume imbalances, when only shadows of the candle cross, and gaps, when there is just blank space between candles, work in the same way as FVGs. The prices tend to come back to these levels. Also, price can sometimes not return in the FVG zone, instead creating a breakaway gap. You can't use these gaps as an entry signal, but it indicates that the move had strong momentum, and the price is not likely to return in this zone. Liquidity concepts. Order blocks are areas where numerous buy or sell orders are located. Bullish order blocks are located at the bottom of the last red candle before the rally. Also, if the price retests the zone and comes back higher, it provides more confidence in the zone. The same way work bearish order blocks, but in reverse. They are drawn from the top of the last green candle. Breaker blocks are formed when an order block is broken, after reaching a new swing high or low. For example, a price comes to the bearish order block, but doesn't fall lower, instead continuing to rally. This zone now serves as a bullish breaker block. And a quick note here, sometimes it's considered to be a breaker block, even if only the candle's shadow has gone further in the order block zone, and people buy at this point. But I recommend waiting for the candle to close, and if it closes higher, look for buys. The same applies when the bullish order block is broken, but as always, it works in reverse. Buy-side liquidity, BSL, and sell-side liquidity, SSL. Buy-side liquidity is a level where sellers have their stop losses, and vice versa. Sell-side liquidity is a level where buyers have their stop losses. Also, these levels are usually marked by the previous day, week, or month, high and low. Liquidity grabs are points at which BSL or SSL is triggered, causing a strong reaction in the opposite direction. In these areas, you usually can see only the shadow of the candle. Liquidity sweeps, on the other hand, emerge when the price stops below or above the level of BSL or SSL and consolidates for some time there, and only then does a strong reaction in the opposite direction follow. Liquidity sweeps are usually created when big institutions execute their orders. Now, let's discuss how traders use SMC. There are three main types of trading where ICT concepts are included. Swing trading, based on weekly and daily imbalances. Trades usually take several days or weeks to execute. Day trading model, based on the previous day's liquidity and structure. And scalping, intraday setups that typically take several hours to execute and are often used during kill zones. Talking about kill zones, they are periods during which large institutions are highly active. Therefore, markets provide great volatility and liquidity. Among these hours are London Open, 7 to 10 a.m. GMT, New York Open, 12 to 3 p.m. GMT, New York Lunch, 4 to 7 p.m. GMT, and Asian Session, 1 to 5 a.m. GMT. Traders mark the highs and lows of these hours. Also, you can find information that during these hours, some assets have particular patterns, which in fact can be true, but it doesn't always work, so I can't recommend it as a reliable way to manage your money. Also, trading SMC usually includes strict money management rules. First, you should look for 1 to 3 and sometimes 1 to 2 risk-reward ratios. When price moves in your direction, after reaching each level of profit, by level I mean the same amount of money as your stop loss. You first set your stop loss at break-even after reaching the first level. Then, after price reaches this level, you put your new stop loss for profit, and then you probably will either hit your take profit or your stop loss for profit. However, some traders don't place their take profits at all. They just constantly move their stop losses higher. The last, but one of the most important, is entry models and examples of how you can use SMC. Let's review them. Example 1. Change of character, break a block, and fair value gap. An example right from the textbook. Price first breaks the current trend and the order block, creates FVG, which is retested with a candle with a big shadow. Given a signal to open a long position, we could catch most of the move. Note, don't forget to put your stop loss after the FVG zone. Example 2. A liquidity grab occurs at the open of the New York session, followed by a bearish fair value gap, which tests this area. Even though this trade is right from the textbook, it still could trick you. This trade would be best executed if you open short position right after the first test, because FVG is rather big, and in order to retain sufficient risk-reward ratio, you have to put your stop loss right after the FVG zone, and if you wait for the beginning of the move, your stop loss will be rather far away, therefore opening this position would be risky. I hope you found something useful and enjoyed the video. Thanks for your attention. Like, comment, subscribe and share with your friends. See you in the next one. Goodbye.